Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing FutureFuel stock by analyzing their financial statements and dissecting their financial ratios to determine if it's a buy or a sell. FutureFuel has two segments, chemicals and biofuels. The chemicals segment manufactures a diversified listing of chemical products that are sold to third-party customers. The biofuels segment began in 2005 and primarily produces and sells biodiesel. It also sells petrodiesel. The company can produce up to 58 million gallons of biofuel per year. Let's get started with the model. This is a small cap company, market cap 538 million. They're trading at $12.30 a share and they have 44 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the future free cash flows and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has pretty healthy free cash flow each year. Net income is the profit and loss on the income statement. It's revenue minus expenses. And the net income seems to be growing each year, which looks good. Revenue is the sales for the company, and it doesn't look so good. It's kind of decreasing each year. It goes from 275 million. It jumps up in 2018 to 291 million, but then drops a lot the next 2 years. This is the company's income statement. The top line is the revenue. Below that is cost of revenue. It seems like the company has really decreased their cost of revenue. Sales decreased a little from 2019 to trailing 12 months, but cost of revenue decreased a lot from 2019 to the trailing 12 months. So their gross profit was the highest in the trailing 12 months, even though they had the lowest revenue. Operating expenses are pretty low for this company, so each year they have a pretty good amount of operating income. They also have to pay interest on their debt and taxes. The company has a pretty good amount of net income each year, and it looks like they're becoming more efficient each year. They're growing their net income by $30 million. This is a breakdown of their revenue by segment, the chemical segment and the biofuels segment. So you can see it was pretty close to even between the two in 2019, 105 million in chemicals and 100 million biofuels. But you can see the chemical segment is fairly steady year to year. They did have their best year in 2015, but after that it's been fairly steady. But biofuels really dropped in 2019. This is a company's statement of cash flows, and operating cash flow is a good number to look at because you want to see how much money the company accumulates through their operational business. So the company generated $87 million of cash flow in its trailing 12 months just through its operational day-to-day business. So that's a good sign. They don't have much in CapEx, and the way to calculate free cash flow, it's operating cash flow minus CapEx. So they have a good amount of free cash flow each year. This is what you want to see when you invest in a company, positive free cash flow. Because if they have negative free cash flow, that means they have to issue debt or equity to fund the business. And as you can see, the company doesn't really issue any debt. They have very little debt in their books. And they haven't issued any stock the past 4 years. So they're funding their business strictly from their operational cash flow, which is what you want when you invest in a business. Let's look at the capital structure. Only $1 million of debt, $467 million of equity. And net debt is the total debt minus cash. And they're negative $316 million. That means if they paid off all their debt, they'd have $316 million of cash left over. That's a good sign. And the company's WACC is 7.5%. That's a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4. That's $895 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $839 million. We divide that by 44 million shares. And we get a calculated stock price of $19.18. They're trading at $12.30, so they're trading at a 36% discount. It's a buy according to the model. Simply Wall Street is a lot higher than me. They're saying the value of the stock is $38, so they're saying it's really undervalued. This is the stock price the last 5 years, and it looks like it peaked about $19, which is pretty close to my valuation. But it's come down quite a bit the last year and a half, 2 years, and it's trading at a pretty nice discount to its all-time high. The company pays a 2% dividend. They pay 6 cents per share per quarter. If you invested $10,000 into this company when it IPO'd and you reinvested those dividends back into the company, you'd have $26,500 today. And if you invested $10,000 and you did not reinvest the dividends, you'd have $21,700 today. So the stock has been outperforming the market, as you can tell from this chart. This is the company production. The black line is biomass production per millions of gallons. The middle line is biodiesel production in millions of gallons, and the last line is mandate. A lot of these chemical companies get funding from the government, so if they produce more than the mandate, they'll get a discount on their taxes. The company's chemical business has 5 customers that represent 38% of their revenue. You generally don't want so much concentration because if one of those companies goes bankrupt or stops doing business with you, this could really affect your company's financials. Because the more concentrated you are in your customer base, the more risky and volatile it can be. In the biofuel business, there's 2 customers that represent 20% of its revenue. Let's look at the financial ratios. The average PE in the entire market is 13.7, the median is 14.4. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 4.7, so they have a really good PE ratio. That means investors are paying $5 for $1 of earnings. That's much better than the median and average. The average price of sales is 6.0, the median is 2.3. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 3.1, so they're between the median and average. The average price to book is 4.7, the median is 2.4. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They're at 1.2, so they have a great price to book ratio. And their tangible book value is $466 million. Their total book value is $467 million, which means they only have $1 million of intangible assets, which is a good sign. The company has hardly any debt, so really low interest payments, so the interest coverage ratio is really high. The average ROE is 10%, the median is 11%. ROE is net income over equity. They're at 24%, that's a great ROE. The average current ratio is 1.9, the median is 1.3. Current ratio is current assets over current liabilities. They're at 5.8, so they're really high in this ratio. You generally don't need a current ratio above 2. That means you're sitting on a lot of current assets. Their current assets are a lot in cash, $317 million, $123 million of receivables, and $38 million of inventory. So if you look at the trailing 12 months, they had $82 million of free cash flow, and they have $400 million of working capital. Working capital is current assets minus current liabilities, so the company is well capitalized. The best way to look at ratios to compare them to similar companies, I've done videos on Celanese and Methanex, both in the same industry as FutureFuel. And if FutureFuel has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So the only reason they're worse in PE is because Methanex has this big negative, so it really skews the average, but they have a great PE. Their price to sales is better than the average. Also, price to book is better than the average. They have the highest current ratio of all the companies. ROE is great. Debt is great, but they're really small, only $538 million market cap. Much smaller than Celanese and a little smaller than Methanex. And their dividend is between both companies. So to summarize, I have them trading at a 36% discount. Their ratios and financials look really good. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.